To watch the full lecture of all subjects, kindly subscribe to my YouTube channel and press the bell icon because whenever I post the new videos, you will get the immediate notifications. Hello everyone, welcome to my YouTube channel. In this particular part video, let us discuss about the meaning of financial management, the definition of financial management and objectives of financial management. Now, the meaning of financial management, it is specialized functional areas of management. There are many functional areas of management. Planning you have to do, organizing. Similarly, the financing is a very specialized functional area. It is concerned with the management of financial aspects of an enterprise. In the enterprises, there will be certain financial aspects, money aspects. So, managing all that money aspects is primary concern of the financial management. It deals with the procurement of funds. Procurement means arranging funds. Procurement of funds is arranging of funds. It deals with arranging of funds. Next, and once you arrange the funds, their effective utilization should happen. Once the funds is procured, their effective utilization should go on. Only when the effective utilization will go on, the wealth of the owners of the business will be maximized. When you have properly utilized the funds of the organization, the wealth of the owners means shareholders. Owners of the business are shareholders. Shareholders' wealth will be maximized. It deals with planning, raising, controlling and administrating of funds used in business. For every businesses, you need to use certain amount of funds. So planning how much fund is required, then raising, procuring the funds required, controlling the usage of the funds. Overall administering of these funds is the financial management. It also includes acquisition, allocation and effective utilization of funds. First one is the acquisition, to acquire the funds from various sources. So we have various sources for acquiring the funds. So we have equity. We can raise the funds through equity. Okay, or else we can go with the combination of equity with preference shares. We can either issue equity shares or preference shares, or we can go to debentures alone, or we can choose a combination like equity shares, preference shares plus debentures. So there are various sources of raising the funds. Okay, there are various sources of raising funds. It is a duty of the financial manager to acquire the funds from appropriate sources. Then allocation, whatever the funds you have acquired, you need to allocate that funds to various departments like purchase department, sales department, planning department, isn't it, HR department. So the funds should be allocated accordingly. Once it is allocated, the effective utilization of funds need to happen. Once effective utilization of the funds is happened, the proper control over the fund can be obtained. It involves judicial planning and management of inflow and outflow of funds. Inflow of fund is a revenue. Outflow of fund is the expense. So you have to balance with the inflow and outflow of the funds. In order to balance it, you need to have a very good planning to balance it. Definition of financial management. According to Isra Solomon, financial management is concerned with the efficient use of an important economic resource. What is that important economic resource? It is fund. So, efficient use of this particular fund is known as financial management. Efficient use of this fund is known as financial management. Objectives or goals of financial management. There are two objectives. First one is specific objectives. Second one is other objectives. Under specific objectives, two objectives can be seen. First one is profit maximization. Second one is wealth maximization. Now, profit maximization. The term profit means what? Profit means we can say that it is a revenue, okay, or the income surplus earned by the business. There is no proper term for profit, but we can say that profit is a income, amount of income earned by the business firm. and which is due to its owners, means it should pay that amount as a dividend to the shareholders. So the prime motto of any business is to earn profit. Any business you take, the primary objective of business is to earn profit. Profit maximization is the most important goal of any business organization. Is there any business who starts telling that I don't want to make any profit? No. All business, all companies will start their corporation with the intention of earning the profit. So profit maximization becomes a very important goal for any kind of business organization. Profit is the only means through which an efficiency of an organization can be measured. If anybody comes and questions you, how efficient is your organization? Then you may tell them that my organization is doing very good amount of profit it is earning, which means my financial position is very good. So my company is efficient. Means the profit is used as a means to judge the efficiency of the organization. Next, it is an economic obligation to cover the cost of funds. See, every business will incur certain amount of cost, isn't it? To overcome that cost, money is required. So, if you want to have a consistency in having liquid cash, then profit is must for the organization to earn. So if profit is there, then we'll have money in hand. Then that money can be used to cover the costs whatever the company has incurred. And if we have more profit, it leads to expansion. So we can expand our organization and growth of our organization also happens. Next is advantages. Many people are for and against. This profit maximization topic has good topic like pros and cons. Negatives also it has and positive also it has. Now let us see what are the positives or advantages or profits in favor or points in favor of profit maximization. What are the points says that yes, profit maximization is correct? First one is that profit is a barometer and the performance of a business unit can be measured. The performance of any business units can be measured by the amount of profit it is making. For example, in my company, okay, there are many manufacturing units. Okay, for example, I am manufacturing shoes, I am manufacturing bags, I am manufacturing books. Now, from shoes, I am earning a profit of 5 lakh rupees. From bag, I am earning a profit of 3 lakh rupees. And from books, I am earning the profit of 7 lakh rupees. Which unit you say that it is performing good? We'll say that the books department is making good, means it is efficient. How did we judge that it is efficient? Because it is making a huge amount of profit. Similarly, the profit is a barometer, and to judge the performance of any business unit, profit can be used. The profit can be used as a medium to measure it. Profit ensures maximum welfare to the shareholders. Okay, if profit is there, the shareholders will invest in our country. The shareholders will do invest in our company because they expect a higher rate of dividend. If higher rate of profit is there, then they will be paid higher rate of dividend. If higher rate of profit is not there, the higher rate of dividend they will not get. So this will maximize the welfare of shareholders. This will maximize the welfare of shareholders. Next, profit maximization increases the confidence of the maximization. So profit is there means there will be a sense of confidence that the management will get. So management will have certain amount of confidence. If profit is there, then the expansion and growth of business will happen. You can diversify your business, you can expand your business, and growth of the organization also happens. So for that also profit is important. Next, profit attracts the investors to invest the savings and securities. Now, if a company is making good profit, okay, it will attract the investors, isn't it? Then the investors will come forward to invest the money in the company. This will increase the funds of the company. What happens if the company is not making good amount of profit? If the company is not making any profit, then the investors of the company will not invest. If they doesn't invest, the company will lack in having funds. So profit is very essential for any business to survive. Profit indicates the efficient use of funds for different requirements. So if good amount of profit is there, then that can be used for different kinds of business units and different requirements of the organization. Next, disadvantages. What are the points against the profit maximization? See, profit is not a clear term. We cannot say that profit is an accounting profit or it is an economic profit, or whether it is a profit before tax or after tax or net profit. So profit is not clearly defined. So when it is not defined properly, so it leads in difficulty to judge what is the exact amount of profit the company has made. It encourages corrupt practices. So to increase the profits of the business, higher profits of the business people may start or may involve themselves in corrupt practices. So they may do some tradings illegally. They may go against the rules and regulations, against the code of conduct of various acts, isn't it? So corrupt practices will start. Next, profit maximization does not consider the element of risk. So in profit maximization, usually what happens, you will plan something, but there is a risk. So risk is the untoward situation, so uncertainty situation. So what happens, you don't know what risk will appear, but you plan keeping in your mind that none of such risks appear in the business, but who knows that such kind of risk may appear. So what happens, whatever you have planned may go wrong, isn't it? So as is an element of risk, you cannot give a guarantee for the profit maximization. Next is, profit does not consider the impact of time value of money. So the effect of time value of money is not considered in the term called profit. So that is one of the disadvantages. Next is, the true and fair picture of the organization is not reflected to profit maximization. So what happens with the intention of maximizing the profit of the organization, the owners of the company, the managers or the directors of the company may simply increase the value of assets, they may revalue of the assets. So the exact picture, the true and fair picture of the organization is not reflected because they have the intention of maximizing the profit. Next, profit maximization is a narrow concept. It is not a broad concept. It is a narrow concept. It's only things in one way, but it is not a broad. Next, profit maximization attracts cutthroat competition. What happens when your company is making very good amount of profit? You have a very good brand loyalty in the market, your company product. So what happened? Many businesses will come forward to give competition. This will increase the competition because many companies will get jealous about you. They'll feel jealous about your organization. So what happens? They start preparing themselves in order to compete with you, isn't it? That is a disadvantage. Then huge amount of profit attracts the government intervention. Means if you attract more, if you earn more amount of profit, if you're earning, what happens? You should pay more amount of tax. So indirectly the tax authorities will have a control of your business. So indirectly which the government will have the intervention into your businesses. So that is one of the disadvantages. Next is estimating the exact amount of profit of a company under the changing world is a difficult and impracticable task. Everything in this world is getting changed. Technology is getting changed, isn't it? So judging the exact amount of profit the company has earned is a very difficult task. Next, second one is wealth maximization. Wealth maximization means the gradual growth of assets or the value of assets of the firm in terms of benefits it can produce. Now, the assets is able to produce the goods worth 5 lakh. Suddenly, the asset is producing the goods worth of 7 lakh. So, there is an increase, isn't it? When there is an increase, it leads to wealth maximization. Okay, it is a net worth maximization. It's also called as net worth maximization, and is a process of creating wealth of an organization. For a company, it should have a good amount of wealth. Creating such wealth is a wealth maximization. Then maximize the value of the firm to its owners. So the value of the firm, the brand value of the firm, the value of the firm in the market has to be increased. That is the main intention of wealth maximization. Next, maximize the market price or value of equity shares of the company. So the value of equity shares, whatever your company has, the value of that has to be increased, which leads to the wealth maximization. Next, wealth maximization is to be a more precise objective of a financial management. So the financial management's the main objective is the wealth maximization. So wealth maximization is expressed as with the formula equation is there. WO is equal to NPO. WO means wealth of the firm and NPO. N is the number of shares owned. Okay. PO means price per share in the market. So if you multiply number of shares owned into price per share, you will get the wealth of the firm. Advantages for this wealth maximization is that the present value of cash flow is taken into consideration. By finding out the wealth of the organization, you will take the present value of your cash flow, whatever the inflow outflow is, that present thing you will consider. Next, we are considering the concept of time value of money. What is the value? Time value of money is considered. So that is an advantage. Universally accepted. This wealth maximization is universally accepted because it takes care of the interest of financial institution, owners, employee, and society. So this wealth maximization concentrates on the financial institutions, various financial institutions, the owners of the company, the employers of the company, and even the society also. So it is universally accepted. Next, it guides the management in framing consistent, strong dividend policy. So what happens every month, it should pay a certain amount of dividend to its shareholders. So a strong dividend policy may be created by the organization. So what happens when a strong dividend policy is created, it will give a maximum return to the shareholders. Shareholders will get the maximum amount of returns. The concept of wealth maximization considers the impact of risk factor. So what happens when you're finding out the wealth of your organization, you do even consider the risk also. So it is including even the risk factor. Now what are the disadvantages? The objective of wealth maximization is not descriptive. Nobody has described like how you are maximizing the wealth of the organization. The concept of increasing the wealth of stockholders differs from one entity to another. So one organization may increase the wealth in one way, another organization may increase the wealth in some other way. So it differs from entity to entity. It also leads to confusion and misinterpretation of financial policy. Okay, what happened? The exact financial position cannot be obtained because the financial policy of the organization may influence in interpretation of the wealth. Next, it is not socially desirable because companies may violate laws in order to increase the shareholders' wealth. Yes, what happens to show more wealth of the organization? They may undergo some corrupt practices, and they may not follow the guidelines given by the various laws. Next, it affects the interest of minority shareholders as shareholders having maximum amount of shares take decisions for their benefit. What happens? Some shareholders may have more number of shares in the company. For them, it will be a benefit. But the person who is the person who has very less amount of shares, it may affect his interest. Next, the other objectives are to ensure regular and adequate supply of funds to the concern. It has the goal to make sure that Every time whenever the fund is required, the fund should be available for the organization. Next, whatever the shareholders of the company are there, they should get the adequate returns, okay, which will depend on the earning capacity, market price of the share, and expectations of the shareholders. Considering all these factors, the shareholders should be given a maximum adequate returns. And this particular financial management has an objective to ensure optimum fund utilization. Optimum means how it should be used in the same way it has to be used. In a better way it has to be used. So optimum fund utilization is enabled. Then once the fund are procured, they should be utilized in maximum possible way at minimum cost. So simply collecting the funds and keeping it with you will not fetch any kind of returns. It has to be invested in some other activities so that the maximum amount of returns you get from that. So, and you should ensure the safety on investment also. So whatever the funds you have acquired, it should be invested in some safe ventures. So what happens if you don't take care of the investment properly? You may undergo certain amount of loss. You may undergo, in fact, huge loss you may undergo. So when you're investing the funds in other ventures, you should have a careful watch on the current market situations, and you should even make sure that you're getting the adequate rate of returns. Next, you need to plan a sound capital structure. Sound capital structure means it's a balance between debt and equity. Now, debt means it considers debentures, loan, preference shares, all these are debt. Equity means equity shareholders. Based on this, equity is the owner's fund. Equity is the owner's fund. So between these two, a proper balance has to be maintained. That is also one of the objective. Next, as I told you, the proportion of fixed asset and current asset should be maintained. So what proportion of fixed assets the company should have, what proportion of current asset the company should have, between these two the balance has to be maintained. Then it should even undergo liquidity. Liquidity means the amount of liquid cash or the fund required at some particular point of time should be well known before itself. Next, judicious planning of assets should be there. Means very cautious way they have to plan so that the maximum returns are obtained with the minimum cost. Next, the efficiency. Efficiency means using less input you give more output, so that has to be maintained. The growth, expansion, diversification, and mergers and acquisition. So if you have more fund in the company, many company will come to join hands with you, so it leads to the growth and expansion of the company also. Then the financial discipline. So what happens, the financial discipline means it is judged based on how well your business organization is performing, how well your business organization is spending, and how well your business organization is able to save fund. Based on all these factors, we can decide whether the company is under financial discipline. This was all about for today's part. Hope you have understood. If you have any doubts or queries, please put all your doubts and queries in the comment box so that we'll respond to your doubts and queries as soon as possible. Thank you for watching the video. I'll come back with the next video. If you have any queries regarding today's session, kindly send your queries to education.mbroadcast@gmail.com.